Carlyle posting its highest quarterly earnings in almost 4 years, boosted by private equity bets and private equity exits. Assets under management rose more than 4% from a year ago to $485 billion. And now Carlyle has ended this quarter with a record $97 billion available to invest. Joining us now with a Bloomberg exclusive is Justin Plouffe, Carlyle's Chief Financial Officer. Justin, thank you so much for joining us.
Danny,
great to see you.
Thanks for having me.
Look, a stellar quarter for exits, a lot of realizations. The conversation for this industry, especially private equity, had been it's gummed up, there's a dam that needs to break. Has the dam broke, or is this just Carlyle doing a good job of selling things?
Well, look, we've been exiting at a very good rate for more than a year now, and our exits have been really broad-based. We had great exits in the quarter from Japan, from Europe Technology, from U.S. real estate, and our U.S. buyout team, they've distributed 23% of fair market value over the last 12 months. That's twice the industry average. So for us, it's more of the same. Capital markets are open. It's a good environment, and we're finding great opportunities to exit and to invest.
Can I ask how those exits are happening? Because, again, part of the narrative had been there's a disconnect between buyers and sellers. Does that mean when you exit, you're having to take down valuations, or is it just the best stuff that you're selling so you can sell it at a better valuation?
Well, it's certainly not that. I think we're finding buyers both in the M&A market. We've also had very successful IPOs in the past year. So we're really taking all opportunities to realize investments when we think it's the right time for to maximize value for the investors. And again, it's been global. We've had these exits all over the world across many different industry sectors. So it's not just one place that is open for exits. Really, the market is open if you have good companies and you know how to find the right buyer.
Speaking of the right timing, we've got this little war going on, and now you have introduced a defense platform.
Yeah, we've been investing in aerospace and defense for our entire history, almost 40 years. We now do have a specific platform aimed at defense and reindustrialization. And this quarter, we actually did our first deal out of that platform, a company called Secturion Systems, which provides encryption to governments and to government contractors so they can send classified information securely. But this is a long-term focus for us, the focus on national security, on data infrastructure. We see an enormous amount of opportunity here, and so we think there'll be a lot of demand for that type of strategy.
Justin, thinking about that platform, some of the big exits you had, Medline, a healthcare company.
Yep.
These aren't exactly like high-flying AI names. Is that a coincidence, or is that a specific choice that you're making not to really chase after the AI trade everyone else is?
Yeah, when we invest at Carlyle, the core tenet is diversification. We've always been diversified across many different industries. You know, our power alleys are aerospace and defense, healthcare, financial services, and we found great opportunities to invest in these spaces. But I think it's important to understand AI as a technology, it's not just about pure play AI. AI is going to revolutionize every industry. And if you look historically at technological revolutions, some of the best investments are actually when a company takes the new technology, figures out how to apply it to their specific industry, their specific company, and then jumps to become a market leader because of that. So we're implementing AI. AI is a big theme. We're just not focused on only pure play AI. We're focused on many different industries.
Do you think there is a risk, though, that this industry, and I guess maybe say for Carlyle if you're not doing it, is getting overly concentrated in AI?
Well, there's certainly a lot of capital demand for AI, and clearly the hyperscalers have put massive amounts of capital there. They're now coming to the private markets to get more capital. But for us as a private markets investment firm, that's an opportunity. If they need our capital, we can be very selective where we put our capital. So is there a risk? There's always a risk, but AI also is going to be transformative, and we're very front-footed about employing it.
You've talked about credit and alternative strategies being strong for you in the quarter. And there have been questions about the private credit market, certainly. How are you navigating that?
Yeah, so I invested in credit for almost 20 years of my career before I became CFO. And I can tell you, in our portfolio, our companies are strong. We're not seeing increases in default rates that you might expect. We're seeing management teams really able to navigate this environment. And it is a tricky environment, especially from a geopolitical standpoint. But our portfolios look very, very good. And ultimately, I think this narrative around private credit, the one thing that will solve it is performance. If our funds funds and the industry continue to perform well as it has in the past, then I think investors will come back and see that it has a place in a well-diversified portfolio.
We are, though, starting to see more broadly public markets, too, spreads start to widen. To be fair, a lot of that is concentrated in tech. But it does seem like a market is somewhat concerned about some of the borrowing levels, especially if the Fed doesn't seem like they're going to cut and might even hike rates. Is there something to that, some of the jitters that appear to be happening, at least in public markets at this point?
So I'd say it's bifurcated. If you look at our markets outside of software, spreads are actually relatively tight still. They're coming off of all-time tights, but I would characterize those capital markets as very open to do business, and new deals can get done very well. Software is a little bit different. It's more difficult to get deals done in the software space. But remember, a few years ago, when rates went up for the first time in basically a decade, people said, wow, there have been so many defaults. These companies won't be able to make their interest payments. And what did we see? Well, management teams were able to handle that. They adjusted their business plans. We didn't see the wave of defaults that was predicted. So this market is very much able to handle different types of situations. We manage through all sorts of environments economically. I think the market will remain relatively strong, even if that happens.
We have a new Fed chair who wants to increase surveillance of a lot of different parts of the economy. And you're a private company, and you say you're doing very well, but how much are you willing to work with them on giving information that would give them a better view into this sort of thing?
We're very transparent. We've always been transparent, regardless of administration. I've been to Washington, D.C. many times to talk to regulators. Our firm was started in Washington, D.C. We have great connectivity there. There's nothing that private markets need to hide. We're very transparent about what we do and what we bring to the economy. Private markets are now so large that they are a massive force in not just the U.S. economy, but the global economy. And we're happy to work with the administration on showing them what really we do every day.
And for the private capital funds, the larger are just getting larger. There's been a lot of M&A. And I have to say, maybe kind of the knock people would say on Carlyle, the reason maybe you're not participating in AI as much is because you're not one of these like behemoth platforms that have this insane amount of capital to invest. I wonder if you would want to grow and if you would want to do it inorganically specifically, because I'm assuming it is nice to grow regardless or not. But would you ever look at inorganic growth? Would you ever look at M&A to get bigger in general?
We always look at opportunities, but inorganic growth is difficult. A lot of things have to work, right? The businesses have to work together. The people have to work together. And right now, we put out a plan in February that was 100% organic. We feel great about that plan. I think our shareholders feel great about that plan. So we don't need inorganic growth to achieve our goals. If something comes along that really is a good fit, of course we'll look at that.
Would it be helpful, though, to be bigger to start competing with some more of the infrastructure deals that are going on?
Well, we're pretty big already.
No, you are. No, you definitely are. No, wait, to be very clear, you are one of the big players, but you're not like an Apollo with an Athene in your back pocket.
Yeah. Yeah. Well, look, Apollo has a very different business model,
Sure.
right? They merged with an insurance company. They have a large balance sheet. We have intentionally been balance sheet light, and for our entire history, we've been a firm focused on investments and investment returns, and we're going to stay that way.
And a fantastic quarter.